Before we jump in today's video, I just want to remind everybody that I'm not a financial advisor. So this video is for educational and entertainment purposes only and should not be taken as financial, investment, or trading advice. All investments involve risk, and you should do your own research or consult with a licensed financial professional before making any investment decisions. Just remember, past performance is not indicative of future results. Hey everybody, it's Paul here on my channel, Better Call Paul, and today I'm really excited because competition in the ETF industry brings innovation. And I think Harvest has been able to face that challenge and come up with two new ETFs that are going to bring some great options for your portfolio. So without further ado, let's jump right into it and see what these two new ETFs are. And then we'll go through some Q&As and find out exactly why they launched them and how they're different and how they might fit into your portfolio. All right, so the first one is HPYE, the Harvest Premium Yield Enhanced ETF. Now, I want to go right down to the holdings, and let's go through the 20 holdings that this ETF is going to hold, because the underlying stocks are really, probably the most important part of an ETF. If you don't agree with the underlying holdings, if it's not something you believe in, then you probably shouldn't be investing in it. So, first of all, we have Apple. Everybody knows Apple. You have your iPhones and your iPads and your MacBooks, right? AbbVie is a biotechnology company, right? Pharmaceuticals. Applied Materials, semiconductors and semiconductor. I'm not sure what the difference is, but obviously this is a growing industry or growing sector. Amazon, of course, everybody knows Amazon. You order everything from there. It seems like nowadays just about packages arrive to most homes on a daily or weekly basis. We have Broadcom, more semiconductors. Bank of America, I believe this is one of, if not the largest bank in the U.S. Caterpillar, right? We all have an idea of what Caterpillar is with their construction equipment. General Electric, aerospace and defense. I would have thought this was more of an electric company, but there you go. Alphabet, which is Google. Again, something that we all use on a daily basis. Goldman Sachs, right? We all like GPIC and GPICs. So now you know where it comes from, right? Here's our Goldman Sachs and JP Morgan, Chase and Company, one of the big banks in the US. Eli Lilly, pharmaceuticals. This is also in HHIS. And then, everybody knows McDonald's, of course, whether you like to eat there or not. It's one of the most popular restaurants probably in the world. We have Meta, or what we used to call Facebook, right? Microsoft, another powerhouse in the tech industry. NVIDIA, everybody knows NVIDIA nowadays, right? Oracle, I have to admit, I don't know too much about Oracle or Palo Alto, two software companies. And guys, this is the beauty of investing in an ETF like this. You don't have to sit down and try to figure out which 20 companies you would invest in, because Harvest has done that work for you, right? Whether it's Harvest or Hamilton or Evolve, they're doing the legwork for you. So we have Walmart, again, another massive store that sort of leads in its sector. ExxonMobil, so you get exposure to oil and gas. And then the Canadian T-bill, 25%, I'm going to assume that this has to do with the leverage, right? The light leverage of this ETF. So the second one is HPYB, which is the Harvest Premium Yield Canadian Bank ETF. And I'm sure you guys won't be surprised to see that this holds the 6 big banks in Canada, right? Bank of Montreal, Bank of Nova Scotia, Royal Bank of Canada, Toronto Dominion Bank, Canadian Imperial Bank of Commerce, and National Bank of Canada. And again, the Canadian T-bill makes up 25%. Okay, guys, so just to do something a little bit different, I decided to take a look at Harvest's question and answer website. and we'll take a look at it and we'll see if we can gain some information about these two ETFs. So what is the difference between traditional yield and premium yield? So why are these premium yield? So Harvest ETFs first introduced equity income ETFs like Harvest Healthcare Leaders Income ETF, which is listed on the TSX as HHL, and the Harvest Tech Achievers Growth and Income ETF, which is listed as HTA, in the previous decade. So these portfolios focus on sectors like healthcare or technology and overlaid those portfolios with an active covered call option writing strategy. So this enabled these ETFs to generate consistent monthly income. HHL is the largest healthcare ETF in Canada, and HTA have both delivered 10 plus years of consistent monthly distributions. In reference to the Harvest lineup, this is what we may categorize as traditional yield. I'm glad that they put in here how they have both delivered 10 plus years of consistent monthly distributions, because there are a lot of people who think that covered call ETFs are just going to disappear in a year or two. And, because of NAV erosion, they won't exist anymore. And, we're all going to have to go back to work someday. So Harvest Premium Yield ETFs, the Harvest Premium Yield Canadian Bank ETF, which is HPYB, and the Harvest Premium Yield Enhanced ETF, HPYE, utilize puts and covered calls to generate twice monthly cash distributions. So there's two new things they've introduced, one being puts, and the second being that it pays twice a month. HPYB and HPYE also employ moderate leverage to enhance yield and produce high income that is paid twice monthly to unit holders. So that's a third thing, right? So we're using puts. They're paying twice a month, and it has some moderate leverage. So this is the changes, the improvements that they've made since they first launched HHL. All right. Why did Harvest ETFs launch the new Premium Yield ETF suite? And you guys let me know in the comments whether or not it helps for me to highlight this as I read it. Harvest ETFs sought to provide Canadians access to a portfolio of big six Canadian banks for those seeking both long-term capital appreciation from the country's largest financial institutions, while also paying twice monthly cash distributions from written puts, covered calls, and moderate leverage. Meanwhile, HPYE allows Canadian investors access to a core U.S. equity portfolio, the Premium Yield Overlay, which utilizes puts, covered calls, and moderate leverage, means that HPYE can generate high levels of income that is paid out twice per month. All right, what was the core investment thesis behind focusing on the big six Canadian banks? Canada's highly regulated and concentrated banking system means that these institutions can benefit from a stable domestic market share, steady profitability, and strong capital buffers. This has helped Canada's big six banks effectively navigate various economic cycles. Going forward, their scale and diversification across retail banking, wealth management, capital markets, and insurance, both in Canada and in some parts of the world, can support steady earnings. Canada's big six banks have a long track record of paying and growing dividends. So that combination of long-term capital appreciation and income generation make Canada's big six banks an ideal pairing with Harvest's trusted option writing strategy. The Harvest Premium Yield Canadian Bank holds a portfolio of the big six banks, Canadian banks, utilizes puts and covered calls in a moderately leveraged portfolio to generate twice monthly cash distributions. Okay, so here's a good question. There are already a lot of covered call bank ETFs. So how do covered calls compare to puts in Canadian banks? So there are a lot of covered call bank ETFs and very few that focus on the put options. This has created a unique opportunity to maintain some of the growth upside while paying twice monthly and having lower downside volatility risks. So what makes the HPYE portfolio an effective way to capture broad equity exposure? So the Harvest Premium Enhanced ETF, HPYE, provides investors access to a portfolio of dominant and industry-leading U.S. equities. These include gigantic brands like Apple and McDonald's, tech titans like NVIDIA and Amazon, energy, manufacturing, and utility leaders like ExxonMobil, Caterpillar, and General Electric, and more. Investors get access to this portfolio of core U.S. equities with twice monthly cash distributions from dynamic puts and covered calls, as well as moderate leverage. How do options provide downside protection? So, to be clear, there are two ways that put options protect on the downside. The first is buying put options that outright protect against pullbacks. The other is by writing put options, much like a covered call option, where writing, say, 5% out of the money means there is still the participation on the full upside to that 5%. By writing put options 5% out of the money, the downside on the first 5% would be missed. By writing put options, some of the downside on the written portion is missed. This helps reduce the downside while still generating the income. So these are the first Harvest ETFs to pay twice monthly income. How do the twice monthly cash distributions comprise a key differentiator for both HPYB and HPYE? So the evolution of the industry has made it clear Canadians want income. At Harvest ETFs, it comes as a natural evolution that we now offer two ETFs that deliver our first ever twice monthly pay period. So the last question they have here is, what type of investors are these strategies for? So Harvest Premium Yield ETFs can be used by many investors. So the first classification they list here is called a retail or DIY investor, looking to access portfolios of core US and Canadian companies enhanced by a professionally managed option strategy and moderate leverage without the complexity of using margin, futures, or options directly. Okay, so the second classification would be advisors and wealth managers seeking to efficiently deliver a sophisticated high distribution yield strategy that combines dynamic put and call writing with core North American equity exposure in a streamlined solution. The third one being passive income investors. Passive income investors looking for high monthly income that paid twice per month while maintaining exposure to established Canadian and US businesses. So I would consider myself to be, I guess, a retail DIY investor, but also a passive income investor. Diversification focused investors. And I guess, probably can categorize myself as this as well. Diversification focused investors wanting a single portfolio that provides diversified exposure to leading companies, consistent monthly income, paid twice monthly, and long-term growth potential without the need to manage multiple holdings or ongoing rebalancing. So far, I think these two new ETFs sound pretty good, and you'll have to let me know, whether or not you liked the fact that I went through Harvest's Q&A to get some more detailed information about these ETFs. But before we're done, I just want to jump back into their website and take a look at the distributions to see where we're going to stand with those. Because at the end of the day, as income investors, that's one of the most important things that we're looking at. All right, so here we are back in the HPYE website. And just to confirm, this is going to be in Canadian currency. I believe this was the price that it launched at. I'm not sure if it actually closed at $12. Keep in mind, this was the very first day of trading. So I'm going to quickly look it up on Wealthsimple and see what did it actually close at the end of the day. So it's showing here $11.98. Um, a little bit different than the NAV, but I'm sure this will be obviously updated on a daily basis. When I looked earlier, I believe this said 2.7 something, unless that was the bank one. We'll have to double check the bank one, but hard to believe there's 4.69 million net assets under management in the first day. So we looked at the 20 holdings already. They classify this as medium risk. And of course, it's active, right? The management style is active with covered calls and puts. It's going to be paid twice monthly. And they're saying the initial distribution is 7 cents. So Harvest Premium Yield HPYE will pay a semi-monthly distribution of 7 cents Canadian per Class A unit, and the first semi-monthly distribution will be paid on or about February the 6th to unit holders of record on January 30th, with an ex-dividend date of January 30th. And the next semi-monthly distribution will be paid on or about February 19th. So that one you have to be on record by the 13th. That's the ex-dividend date is the 13th. Now, I did the math, and unless I did it wrong, if you take 7 cents and you multiply it by 24 and divide it by $12, this should be a starting yield of about 14%. But of course, Harvest can't state anything like that until the fund's been around for a year, I believe is the way it works. So let's quickly go back into HPYB, and yeah, you can see this one is 2.37 million. So this one is not quite as popular as the other one at the moment. The distribution is identical. So guys, like I was saying at the beginning of this video, I'm very excited because the more competition there is in the industry between Harvest, and Hamilton and Evolve, and now even 9 Points, Global X, right, BMO. So the more competition there is, the more these companies are driven to come up with even more efficient and better strategies. So we're going to have to wait and see, watch how these funds perform as the market goes up and goes down, how well they ride up with the market. And then when the market goes down, how far do they drop? How much does the puts protected on the downside? And then once it drops down, how much is it able to recover? Because at the end of the day, we want to see that our share price and NAV is fairly stable, consistent with the market, and that the distributions maintain themselves. So I'm really excited for this. I haven't quite decided yet where in my portfolio this is going to fit. As you all know, I'm trying to reduce my portfolio. I don't like having 33 holdings. So I'm trying to figure out which ones I'm going to sell. And the first, I think I sold already. I dropped down from like 42 to 33. Those ones were pretty easy, but now it's getting a little bit harder, right? It's getting a little bit harder to determine which ones I want to get rid of. And I also hold some US listed and some Canadian listed. So I think that's one of the reasons why I have as many as I do. But I will take a look at these ETFs for sure and try to determine whether or not they're better suited for my portfolio than some of the other funds I currently have. Maybe I'll swap some out and put them into these. It is nice getting paid twice a month. I think some investors have gotten a little bit too fixated on getting paid weekly or getting paid twice a month, but it is definitely high in demand. So, obviously Harvest has listened to what people want and answered that with these two funds. So let me know in the comments what you think of these funds, and let me know again what you thought of the Q&A from Harvest that I went over with you guys. I guess it saves you guys a little bit of time. You don't have to go on the website and, read it yourself. You can just listen to it as you go for a walk or, maybe driving to work. So guys, just remember, as stated at the beginning of the video, and every video now has to basically remind you that, just because I'm talking about these ETFs doesn't mean I'm recommending them for you, right? Everybody has different risk tolerances. Everybody has different financial needs and a financial plan, right? So that's up for you to determine. And if you have to hire somebody, even if you pay somebody by the hour to help you figure out your risk tolerance and what your financial needs are for the future, it might be worth doing. All right, guys. So until the next video, bye for now.